Hello, everybody. I've done like 10 intros, and I think this is the last one. Tech difficulties, things of that nature, but it's all right. I'm Nathan Martin, the owner of Atlantic Financial, and your host for the evening or morning, depending on when this comes out, for AIR Atlantic Insider Review. Yeah, and thank you for joining me. I know it's a small following, generally just people I know, friends and family, maybe some clients, some prospective clients. And then if you are a viewer who is out of the area and you're just looking for the free content, I can assure you that this is going to be information packed, jam packed, something that you're going to find pretty interesting from start to finish. But with all that said, I do want to get my disclaimer out of the way really quick because we have a decent amount of stuff to get into. Um, Everything I discuss on this show is for general information and education only. Nothing here is personalized financial, tax, or investment advice. Atlantic Financial Management is a registered investment advisor in the Commonwealth of Pennsylvania. For full disclosures, visit AtlanticFinancialMNGT.com. Nothing that I say here is a call to buy, sell, or hold any positions. So, with that said, it's been an interesting week. I had some drama with YouTube already, which I can't believe. But man, they shut off. If you're joining me from the video that I made about Cuba, that video got like shut down like a light switch. And I'm posting the picture here so you can see. But it was crazy. I was like, did I do something wrong? I do a lot of deep research just because it's important for me and for any clients watching. Anybody who's done business with me for a while knows I have an answer for what's going on, or at least a speculative answer. And it's my job to know what's happening so that when somebody says, hey, look, how is this going to affect my portfolio? I can have, an educated answer on what could be happening. So I was just doing some research, stumbled upon this crazy information about Cuba and Russia and China. And I was like, this is interesting. Let me, put this up. People can look at it, decide for themselves what's going on. It's interesting. At the very least, it's entertaining. And, I was like, woke up the next morning. I was like, wow, that's quite an amount of people to look at that. And then, like a little bit throughout the day, I checked on it because I was pretty surprised. And it's like it shut off. And so, I was like, did I do something wrong? But we're not here to talk about that either. That's not what the channel's about. This is more so about just general news topics and things like that. But I was like, what did I do? But we'll get right into it. So, first story, OpenAI is officially preparing to stage their IPO. The company led by Sam Altman confidentially filed their IPO paperwork with the SEC. So this really has been a huge IPO season between SpaceX, which IPOs today as of the recording of this, which is Friday. Then you have OpenAI, and then you also have Anthropic. So three huge names are going public. Very interesting to see what's going to happen with that. And do your discretion. Again, nothing that I say is a call to buy, sell, or hold any positions, but people need to be aware of some of the things that go into these IPOs. There's a lot of headlines that are going into the SpaceX IPO, and that might draw some. And this I'm saying might, but it might draw some speculative investors that are looking for short-term gains. It's happened before where IPOs come in, people put a lot of money into them, and it takes there's shaving at the top, and it takes a few years for the IPO to get back to where it was when it first hit the market. A great example of that is actually Coinbase, and forgive me for doing some of this stuff real time, but I'm finding as I start doing this, there's a lot of stuff that I try and prepare for, a lot of research so that I can give good information and good topics for people to go over. And then there's things that come up through speaking where you're like, oh, okay, there's no way I could have thought that through. I would basically have to do this entire thing once before and then come back again and go through it all. So forgive me for going through and doing this real time. That's kind of how it's going to be moving forward. Honestly, I think that's the best way of doing it. So yeah, Coinbase, and the reason I bring this up is because I got burned on Coinbase because I bought Coinbase at its IPO when it IPO'd at like $300, $381. I literally bought that day, and then I bought at the dip. I was like, oh, it's going down. This is great. I'm so fortunate. Let me buy more. And I got so burned. So it is what it is. You live and you learn. An IPO doesn't mean it's going to go the way you want it to. And some of the reasons for that is just because you have investors that may, and I was uneducated too, I guess you could say at the time, but you have investors that they invest, they aren't educated on what they're buying into, and they may not be able to properly evaluate a company. I'm not saying that's what SpaceX is or that's what's going to happen, because it could, anything can happen. If you are in the investment space and you are investing on behalf of people, or you're a high level investor yourself, you realize that anything can happen, truly, good or bad. Um, and sometimes when you're developing trade strategies, what you're really doing at the end of the day, and this is a very light way of explaining it because it's a lot more in depth, but like a lot of things, it's easier said than done. Um, Investment strategies a lot of the time are a win percent, a win rate, and it's like, all right, well, we have a win rate of 70%. It's important to know that 70% of the time when you see X, Y is the result, but it's not every time. And that's what I mean when I say anything can happen. And even if that is the case, even if 70% of the time you are able to achieve what you believe you can achieve, there's also what's called black swan events, which are statistical anomalies that do come up, especially over the course of time. So you may have a strategy that reliably has been, 7 out of 10 trades you've profited from, or 7 out of 10 positions that you've moved in or out of, has been profitable. Eventually, you'll hit a black swan event where that could be the inverse, and that's what separates a lot of different people. Is okay, I've developed this trade strategy. Now all of a sudden, it's not working out of nowhere. That's where people lose their minds, because then they'll leave the strategy, then they corrupt their own data, and ultimately that's you know not always where you fail. I got to be careful about the generalities, but that's where you can fail, is by not maintaining your strategy. So, and that's not a call for anybody to do that on their own. If you're thinking about doing something like that, you should absolutely consult a financial professional. You can consult me. More than happy to help you out. My number is 267-835-2403. So if you are looking to get into that, let me know. But yeah, so OpenAI, they're officially preparing for their IPO. It'll be a blockbuster season. We'll see. Another interesting story that I saw: 99% of on-time arrival performance for Pepsi's driverless trucks. Not a call to buy, sell, or hold. Which is, very interesting that we could be seeing a world where, the robots really are taking over. And if everybody remembers, back in like the early 2000s, the big craze was robots are taking over. There's going to be no blue collar jobs. You need to be white collar. And it seems very ironic that, in about 20 years, it's completely reversed. And you have people who are saying, oh, the robots are taking over the white collar jobs. It's blue collar that's safe now. So it's just it's interesting because now we're seeing somewhat of a resurgence of the driverless cars. I believe it's like Waymo's. Now you have Pepsi's driverless trucks. I know Amazon's using the drones. So we're seeing a really stark rise in robot automation. So it's interesting. Make of that what you will, I guess. So here's another one. So I was actually surprised to see yesterday or today, Europe actually rose their rates only by a quarter percent, 25 basis points. They rose their rates. They were actually looking like not they weren't going to do that. They all seemed very soft on that approach. But here's another. So what I find interesting and fascinating is sometimes things that you would see that are the counterintuitiveness, right? Where you're looking at something and you say, oh, well, it should be this, but it's really not. Like that weird statistical anomaly that in a room of 23 people, you have a 50-50 chance that two people will have the same birthday. Um, so too is the market sometimes. So there was actually a stronger than expected jobs report, and that sheared off 4.2% of the NASDAQ composite. And you might be asking yourself, well, if jobs are going well, if we're having economic growth, why would that cause such a stark drop in the value of the Nasdaq or the market in general? And the reason being is that signals that the Fed may raise rates. And the Fed's already, Kevin Warsh has already been the kind of guy who's signaled that he's not afraid to raise rates. And I know his economic background, the people that he studied under, people he studied under, the people he studied under aren't fans of the Federal Reserve, ironically, but if they were in his position having to deal with the Fed as it was, they would also be open to rising rates in some of these situations, especially with the money supply that we have, would be their primary goal to raise rates to increase the value of the dollar. And with that said, and then with stronger than expected jobs, the Fed could cut or excuse me could increase rates. And you might be asking yourself, well, why would they increase the rates if jobs are going well? And the philosophy of the Fed is, as an economic standpoint and almost as a social standpoint, they'll raise or lower the rates depending on how the economy is going. So when the economy is slowing down, now as they've backed themselves into a corner from all the money printing, so it's kind of tough for them to manipulate the rate in ways that they could in the past. Um, and there's arguments to be made against that, but I would say that they've put themselves in a corner. Also, with the artificially low interest rates, they put themselves into a corner. But that said, they're able to raise and lower the rate to keep the economy in a form of steady growth. And that's the philosophy. I'm not saying that that's what I believe. I'm just saying that that's their philosophy. Is when the economy's heating up, it could overheat, is their thinking. It'll overheat. So to avoid a huge pump and dump in the economy, what they'll do is they'll raise interest rates before that and keep the economy in check. Vice versa, if they're seeing stagnant growth in the economy, they'll lower interest rates until they start to see some growth pick up again. So it's a way of them ultimately attempting to avert catastrophe, avert an overexpanding economy before it heats up too much, or avert stagnation before the economy slows down too much. They can kind of control that with the interest rate. So what investors are doing when they look at look at the jobs report being as high as it was with that much growth, they're saying, okay, it's they believe, or at least 4.2% of them, or of the money that's in there, believes that that's going to signal a rate increase. So it's very interesting. And then here's the other really interesting thing is, with the war going on in Iran, and like we've seen costs increase in a way that we would see with a rate increase. Maybe I'm jumbling my words up too much. So judging off of what we just went over, right? If the Fed increases their interest rates, that slows down economies, overheating economies. Well, we just had job growth, yet we're seeing prices go up because of the cost of energy. So one of the things that's happened is, um, with the increase of the cost of oil, that's had a very similar effect that interest rates would. So technically, in some ways, the Fed, when they would have otherwise raised the rates, may not have to because the cost of energy has spiked. So they're essentially getting the same effect without having to do anything, which is very important to know. Again, if you saw my last breakdown, and I do have something that I should get out of the way immediately, but if you saw my last breakdown, you'll see that I absolutely think that there's a huge oil influence on what's going on. I definitely, and I have refined my point, and I'll just get out of the way now. I was wrong about the north-south intercontinental, or the intercontinental north-south corridor. That's actually mainly used for dry goods, and the infrastructure there isn't. And I knew that when I was talking about it, but I was like, well, I didn't know the dry goods part, but I knew that the infrastructure wasn't really there. They haven't really built it out. There's not much that moves through there. But I was like, yeah, maybe with all that's going on, they might have been strategizing that they're going to push more oil or something through there down to Iran, um, and down through Iran to India. But it really isn't that. They don't use it as much as I even thought they could be. So sorry I got that wrong. But um, yeah, I do still maintain the belief that this is still over oil, kind of preceding the second half of this, because the second half will be all about the conflict that's going on. Um, just to kind of give a little bit of an idea of why I think that, we saw, so I don't want to put the cart before the horse, but I always do this. I'm just going to keep it quick and then move on. But it will segue into a good um, point next. But immediately following Ukraine, Russia shifted there. So after Ukraine happened, it cut off half of Russia's oil buyers, crude oil buyers, right? And it is important that it's crude oil. It's the precursor to all the other petrol products, right? And that's a big industry, a very big industry, specifically in India, is refined petroleum products. I forget how many. I'm not going to get into it. I'll get into it later. So stick around. But um, yeah, half their imports were going to Europe. They shifted, and currently, before um, the conflict in the conflict in the Middle East, and I believe they're still looking to achieve this now, but it's basically the big three buyers, starting with China at a little over 50% of their oil, I believe. India is 30%, and then Turkey is 10%. India took advantage. India has the infrastructure to refine petroleum products, specifically into like diesel and jet fuel and things of that nature, gasoline. So that's like their second highest export behind car parts and car manufacturing and parts of that nature. I'm going to get into it a little bit more. They even purchased a significant refinery or oil field, I believe it's a refinery, in northern Siberia. They're the only country that I know of that has any claim on Russian oil and their oil infrastructure. But the big thing that they would do is they would import. They were a net importer of crude oil. Um, more, well, I shouldn't say more, but a decent portion of the reason why they imported it is because their exports, one of the ways that they would make money, their second highest export, was the refined petroleum products that go out into the world. So, um, what was great for them was when Russia was sanctioned, they were buying Russian oil at a discount. So they were like, they're making a killing. They're like, we're buying this Russian oil at a discount, which it boosted their profit margins, understandably. But with what's happening with the Strait now, India is stuck paying a premium on Russian oil. So they've kind of backed themselves into a corner. And then they also made such a big commitment with and I'm going to double check all this before, or not double check this. I know what I'm saying is correct, but it's an oil field or a refinery up in northern Siberia that they purchased. But I know they own like 49%, almost right down the middle. And they purchased that. I'm not even going to put the dates on because I'd probably be wrong, but they purchased that. So they're just so intertwined with the Russian oil economy right now that it's tough for them. to move out. But one of the other things that I noticed was um, there's rumors going around, nothing very specific, but it's looking like it's rumored that around the globe there's been two energy crises now within the last 10 years. And it seems that these high oil prices are probably here to stay. And the reason for that is, again, this is the rumor that's going around. Countries, once we do solve this oil conflict and the oil market opens back up again, you're going to see countries conserving their oil and building up oil reserves and having higher strategic energy reserves. That's going to be coming. So this conflict, let's hope that it doesn't hurt the infrastructure, because that'll keep the prices high for a while. But along with that, so many countries are now spooked because of the oil conflict that they're likely going to retain an extra amount. So, as you would know, if you have good financial principles, you have an emergency fund. Well, maybe during COVID, your emergency fund got taxed way too much. So now, when maybe you lost your job or whatever happened, your emergency fund went down to zero. Maybe you went into some not good debt. Whatever happened, that happened to you. Now you might be like, all right, well, now that I am in a better position, I'm going to save even more than I otherwise would have. And you can start to see through that lens and through the oil lens how markets can be affected, um, even more than you might initially think. So even if the strait does open up tomorrow or next week or next year, who knows when, um, you're still going to see some after effects from this. So who knows? And anything can happen, really. So, maybe it's not as big a deal, because I do know there is a shelf life on oil. So there's a bottleneck there. So countries may not want to, or I shouldn't say may, depending on what they do, it might not be as feasible, and maybe that strategic reserve just hits a point a lot faster. So I don't want to say we should, but we could see an after effect of this where oil prices remain a little bit high as countries, build up their own national reserves and don't necessarily push that down to the consumer at the consumer level. So we'll see. We got to wait to see, as always. Another interesting thing, sales of existing homes actually rose 3.2% over the previous month, to a seasonally adjusted rate of 4.17 million, the National Association of Realtors said. So there was a forecast. We exceeded that forecast by 0.7%. So yeah, I mean, I don't know. I know the rates went down. People are done waiting. Um, I really don't know what to make of it, because conversely, and I'm just going to scroll down and get into it, and then I'll come back to where I was at. But that private credit fund that I talked about last week, where we didn't have a number on how many people were trying to pull out from the fund, we just knew that they capped it at 5%. Well, now we have a number. It was 13%. They are facing 13, over a tenth of the fund. I don't think I said the name. If I did, I'll bleep it out. But yeah, so they're facing a 13% redemption request, and they're capping out at 5%. So, again, it's just, this is a very 2008 like scenario where, they're in the same space. You have district attorneys from New York, I believe. I know it's attorneys, but you have people going in saying, "Look, this can't possibly be true. Like, your valuation is just not accurate to what the actual cost is." And then you also have, paired with that, people looking to pull their money out, and I believe they said that all redemptions would be allowed. So them saying that you're not allowed to redeem shares because they've gone past 5% is also very interesting. So just so you know, and always read the fine print. I will say that, because when I first started investing and getting into this, there's a lot of places that make it very easy to invest on your own and get into this space. However, you need to read the fine print, because there were certain there were certain platforms that said if we see um, a certain amount of a sell off in a certain area or certain investment, we'll shut it down on our end. And I just never invested with those platforms, right? So you need to look and make sure, okay, if I do invest in this area, how liquid is it? And that's not to say that illiquid investments are a bad thing. Sometimes they can be very profitable, but you just need to know what you're getting into, because if it doesn't fit your strategy, then that's a problem. Again, always consult a financial professional. But if your strategy is very short term or could be short term, then you don't want to tie yourself into something that you couldn't get out of. Now, if this is money that you're not planning on using for a very long time, then that's money that you probably could put into something that you couldn't get your money out of. And it's also not to say that that's a good idea either, because it might not be a good investment. So just because you can't get your money out doesn't mean it's the best investment. So, or best is subjective, but doesn't mean that it's going to be a profitable investment. So, um, yeah, and I do offer a lot of free advice. If you're one of those prospective clients or just regular listener, and you have questions, give me a call. I done so much free work. I mean, this is even free work for me. Putting all this out there, so kind of giving you an insight on some of my experience within reason. So, yeah, so we're also seeing this is not a call to buy, sell, or hold. Semiconductors, miners, and banks are the sectors that will outperform among European equities, Morgan Stanley analysts write. And yeah, anything can happen, but I could see this being true in some ways. There's a humongous push. There's infrastructure pushes, and generally, when people are generally, I say that very specifically, but generally, when there's a huge push for infrastructure, that does signal a long-term strategy, and with the certain national security risks that some of these things pose, um, yeah, semiconductors are important for building AI software. And like we spoke about, the data center rollout that we have going across the country is significant. And ultimately, miners are going to be the, you need to have these raw materials in order to build. So it's not, you can't do this in a vacuum. You'll need everything from farm to table to get this done. I don't understand why the banking sector is going to outperform European equities. I probably have to do a little bit more research into that. But let's see. They're saying, actually, I have it in here. They're saying as a result of higher yields on deposits. Um, sure, maybe. I mean, it's always going to be a maybe. There's probably going to be people who are pretty upset that I'm saying maybe to that, but maybe. Competing with the European market, I don't know. Okay, higher yields. All right, maybe. I'm not completely sold on that. That's not a call to buy, sell, or hold, but all right. Moving on, U.S. debt sustainability concerns pose a risk to the dollar's valuation. Danske Bank analysts saying a no. And sure, um, sure, and that would be a problem if we weren't the world's number one economy or number one, global superpower. Um, and I do agree in a lot of ways that the devaluation of our dollar is significant. But again, I would say to that, so Greece's currency collapsed. They have nothing to peg their currency to. The United States can peg their currency to oil. So when we look at our debt, it's not that the debt is a good thing, because I don't believe it is. However, our dollar still has value. It has enormous value because that's how you get a seat at the table, through trade. I think that's the huge driving factor behind our presence in the Middle East, because as you saw on the map last week, if you were here, and I'll show it again today, I'm sure, but our oil infrastructure in the Middle East is extreme. Our military presence surrounding the oil infrastructure is extreme. Um, and you got to question, why would we invest so much military infrastructure, so much social capital into this area? And it's because the U.S. dollar is backed by oil, and that's our power and influence over the world, and we can expand and constrict. So similar to how the Federal Reserve can expand and restrict the economy through interest rates, we too can expand and restrict um, other governments through trade. And that's why it's a big deal. When everybody was saying, "Oh, Russia, the sanctions, this, that, third," and Russia's doing all right. That's why it's a big deal, because you know we were banking that Russia wasn't going to be doing all right. And I don't know the complete ins and outs of the Russian economy. I've only just started scratching the surface of their oil economy, which is, it's important because it's half of their imports, or excuse me, half of their exports is oil, liquid natural gas, and coal. So energy and some petrol refinement. But yeah, I mean, we'll see. The debt isn't good. I don't know when the debt will get so big that it causes our dollar to collapse, or if that even will, because again, like I said, the value is pegged to oil. So um, I'd probably need to do some very serious thinking to give a decent answer in response to that. But of the thoughts that I have had, who's going to come and redeem that debt? And I'm really not trying to cause any arguments or anything like that, but I would just say, as a practical nature, I understand as a philosophical nature, it's fiat currency, it's not really real, but it really is real, because the enforcement of the United States Navy and military on trade and trade goods through the US dollar, and then sanctioning anybody saying you can't use our dollar, cuts them off from energy. You know what I mean? And it's like, all right, well, if like, so you could kind of see where I'm getting at there. It's there's a lot of value in being able to use it. So I'm not going to get on a tangent with that, but I just want to put out that person's perspective and kind of take the opposite side of that a little bit. And it's not completely opposite. I don't agree with the debt. I'm just saying it's not. It's questionable. But the the Fed is, for the first time, and this is very intricate stuff. The Fed is, for the first time, negative on the balance sheet by about $200 billion, I believe. So, that's not good, but really, like, what's going to happen? It's not like you're going to have um, the Fed send debt collectors to Washington, D.C. So, um, and also inflation came in at 4.2% in May, highest level in 3 years. Um, so, again, it's very similar to hiking the interest rate. And if we're at 4.2%, I would say, if that's the highest that we've had in 3 years, that would signal that we're going to stay flat. I was surprised to see that Europe increased the interest rate. But again, I just think with inflation like that, with the war in the Middle East, I wouldn't imagine that we would be increasing the interest rate at this point. So, and again, like, this is one of those things, like, countries can leverage, hey, look, there is a conflict, energy prices are higher, maybe we don't need to actually increase the interest rate, because the effect that we need, an overheating economy, that jobs report, just because the jobs came in at higher numbers. Let's also look and see energy costs, or at least energy costs have pumped inflation up by 4.2%. So maybe we don't increase the rates. We'll see. And Canada, for that exact same reason, that's why I put it right there. Canada, for the exact same reason, isn't increasing their rates for exactly what I'm talking about. But they didn't have a big gain in their labor market either, so they're also just in the spot. And then this is interesting. So I might have mentioned it last week, but I'll mention it again today if I didn't. Uh, Across the country, it seems that truckers' average travel speed has dropped by 5%. The reason for that is they're trying to expand the longevity of their gasoline, be more fuel efficient. we see, and there's a whole, I mean, it's been, I've really gone too deep, and maybe I should find different parts of the economy to go into. But it's been fascinating to kind of research oil and how it's pegged to the dollar and how it's, led to a number of different tensions across the world, energy and the transport and trade of it. But you can see there's been a sharp fall in China's crude oil imports during the Iran war. That wasn't actually the best worded headline. I'm reading the headline as I go through, but basically, um, obviously, they're not getting the same amount of oil that they once were. But it seems that the country as a whole has cut uh, their oil usage. So very interesting. I mean, we know that China is a very cohesive and um, cohesive country. They have state mandates, people get behind it, and it just seems that the people are behind it. They're sitting here and they've reduced their oil consumption. So very interesting to see that many people can turn it down that fast in response to something like this. But it's also to note, um, when this all started, there was all these crazy trades that were going on, and you could see that people were shorting the market, people were doing this, people were doing that, and I was listening to somebody talk about it, and it's, in some ways true. All of those movements that happened in some way, and I could look and probably look at the chart and see where they were coming from this, because it is a pet theory of theirs as well. But when you move through the market in that way, so when it comes to commodities trading, you have the price that you see on the screen, and then you have the price that people are actually paying. And one of the ways that the oil market was essentially manipulated by these big macro bets was it allowed the stability of the screen price, while the actual pay price, what ships were paying, um, what countries were paying, that price skyrocketed. Yet the screen price, the price that people were paying on paper, stayed relatively stable in comparison. And you can even look on the charts. I'd wonder what it is today to see if it's balanced out. But you can see on the charts, it was like literally the biggest disparity between the paper price and the real price of oil. So, there's a bunch of different strategies around maneuvering through these economic situations. A lot of very smart people uh, who, look at these strategies and try and figure out, okay, well, how can we profit from this? The markets do like stability. So, like I said, I mean, it goes so much deeper than you'd imagine. The different intricacies of different markets, and also what people have to offer, right? China imports a ton of oil. They also export a ton of goods, precursors to different medicines. So what they have for the world, rare earth, minerals, and some of their derivatives. So it's just very interesting to see how countries and markets try and deal with these different scenarios. China will work with its people to drive less, use less gasoline. America will stabilize the computer price, and they were able to do that. And that's like the pet theory of the person, and I would actually think to agree with them in a lot of ways. But we didn't feel the real price immediately either. If everybody remembers, like, this war happened and we still had like $2.80 gas where I'm at, 2.90 I think, and then very slowly, but it was delayed, did we get to what we're at today, like 4.25. So and the reason for that is just from shipping, like literally sheer time. Um, the agreements for the oil that was already on its way here, there was like a 2 week backlog, right? So everybody had already paid up for $2.80 gas, and it was going to take 2 weeks to get there, or a month, I think it was actually, to get there, when the conflict started up again and the strait was closed. So we had a delayed effect. but now we're starting to see the after effects. So, and I'm getting wrapping up on the first half of the show. I think that might actually be it. So, I'm going to take a quick break, kind of compose my thoughts, and then we'll get into the second half and specifically kind of like two top stories. We're going to go through Iran, and then we might go through a little bit of the Russian oil market,